What's worth more, a $10 bill or two $5 bills? They're the exact same, right? Well, although it may seem simple, when it comes to the stock market, investors are often fooled by stock splits. They pretty much change absolutely nothing. But if it weren't for stock splits, some share prices would reach astronomical highs, which means investors wouldn't be able to afford them anymore. Just look at Berkshire Hathaway's Class A shares. So there's an argument to be made that there is some benefit to it, which I'll cover shortly. But first, what exactly happens in a stock split? Well, the share price is reduced and existing shareholders are given additional shares. So for example, if you owned one share in a stock trading at $10 a share, which announced a 2-for-1 stock split, you would now own 2 shares in the stock after it splits to $5 a share. In both cases, you have $10. Note that reverse stock splits are possible too, which would simply be the reverse of the case I just mentioned. Now, here are some legitimate arguments that stock splits are positive news if you are a shareholder. You can now invest more of your money in the company. How so? Well, in the case I mentioned, if you had $16 to invest, let's say, then you can buy only 1 share pre-split, which represents $10. After the split, where the stock price is now $5, well, you could purchase up to 3 shares, which amounts to $15. Recently, as we saw with Tesla's stock split, it makes it more accessible to new investors that might not be able to afford the higher price. And just that anticipated demand can be a tailwind for the stock when it announces a stock split. Also, if you enrolled in a DRIP, which I covered in another video, then a reduced share price implies that more of your dividends can be reinvested in the company, which is good for you. However, here's some proof that stock splits are actually completely meaningless. So although the share price is cut in half or cut into 4 or 3, it doesn't really matter. It's typically cut in half. The stock isn't actually any cheaper. So recall from my PE video that we use the price over the EPS to determine how expensive a share price is. So although the price gets cut, let's say in half, the number of shares outstanding has just doubled, which means the EPS has also been cut in half. So the PE ratio actually remains the exact same. A stock split is just typically a reminder of, wow, it's gone up so much. But the split itself is not the positive event. And sometimes a reverse stock split is made to meet regulations or to seem less risky to investors. Like, hey, look, I'm not a penny stock anymore. So really, companies can just artificially change their share price without actually changing the value to investors. At the end of the day, it really makes no difference. The stock does not become cheaper. It just seems that way. Any marginal benefits are likely offset by the increased filing costs the company incurs to go through the whole process. So don't be fooled. I hope that clarifies a few misconceptions about stock splits and that you are prepared to educate your friends next time they get excited about a stock split.